why quant mutual funds are more volatile than the market.
2026 will remember as the PE contraction phase.
What's that one thing that investors should stop doing immediately in India?
We have written a massive rally will start in precious metal. How we got it? Gold or silver should be part of your portfolio, and we have been vocal to say 10 to 20%. After Venezuela, which is the best other country, produced Nigeria. You already seeing trouble starting in Nigeria.
What do you consider a PE as a high PE?
I virtually came at the peak of the small cap cycle. Now I'm stuck. If you have 6 years horizon, anytime you have come in the market and made a small, you have made money.
That's absolutely fine. In the next 55 minutes, you're going to listen to Mr. Sandeep Tandon, who is the founder and CIO of Quant Mutual Fund. Sandeep has been in the stock market for more than 33 plus years. He's a data-first investor and have seen multiple bull and bear cycles. Sandeep is a thought leader who has taken Quant's money under management from 35 crores to more than 96,000 crores. In this video, you're going to learn what type of stocks are likely to do well in 2026. How Quant predicted gold and silver rally back in 2018 using cycle analytics, impact of geopolitics on stock market, and where is the next crisis going to be, concept of sector rotation, and much more. Before we start, a humble request. If you have not yet subscribed to this channel, please hit the subscribe button because your subscriptions will ensure that I continue to bring quality content for you at zero cost. Enjoy this episode. Sandeep ji, thank you so much for today's time. One of the common questions that people are asking right now and they're trying to find an answer for is why quant mutual funds are more volatile than the market. What do you have to say to them?
So the answer is very simple. Okay, let's understand how we manage our schemes. Okay, we are truly active money manager. Okay, I have been in industry for a while and I have been servicing as a broker also to most of the institution. What people do most of the time, they try to hug the indices. Okay, when I say the hug the indices, let's 70-80% will be weighted similar to index, and somewhere you talk about minor outperformance, minor underperformance. This is what I have seen a common observation. So when you offer a quasi passive product, okay, then your returns will be similar to the index. When you run a proper active fund, your returns will be more volatile as compared to passive. So obviously in bull market, it can outperform decisively, which happened. We have outperformed decisively in last 5 years, you look at. But in times of when market is falling and your particular stocks which you have built a concentrated bets, if they correct, so obviously your impact will be more for you. Now it's a question of how you want to offer a quasi passive product. I think industry offers that. We want to be very different. We are active money manager. We take the fees of active money manager and we will be offering active products. So our audience are also very different. We are saying people who are willing to take bets on markets, actively manage portfolio. Those are the type of investor which we need. If you are passive, then you can get into a passive product or quasi-passive product. But we offer proper active money management.
Right. Okay. I understand that Quant AMC, your mutual fund house, primarily rely on data analysis, predictive analysis. Is that what is giving you that confidence that you need to be driven more in terms of looking at the market dynamics, and therefore you pick up the pockets where you find more opportunities, and that might mean that there is slightly more risk versus a normal index that you're looking at?
So Rahul, let's understand. It is true we manage money through data analytics. Okay, we very proudly say objective is religion, data is God. So everything revolves around data. Okay, now if you look at in last 33 years, we have built these analytics. We have invested $24 million in building analytics. Now if you really look at, take you as an example of an individual. You want to buy a house, you want to look at stock, or you want to take any decision. How you will take a decision? Based on your experience, or you will consult the specialist? And based on multiple data points, your conviction will move up to take a call. Okay. Similarly, when we take a decision, it's a very data driven. We don't take call on the markets in general. Okay, I like it, or this sector looks good to me, or this is the way it should be. No, we are completely unconstrained fund house We are slave of data. Data is God. Whatever data is saying, when we run predictive analytics, when I say predictive analytics, we are trying to connect the dot on multiple analytics, and whenever data points is skewed on one direction, we take bold and aggressive view on either way,
Right.
either on the selling side or on the buying side. And that makes a lot of difference from the traditional approach. Why I'm saying that, let's understand, we live in a very dynamic world. Okay, data points are changing. Today statement is coming on the Greenland or something on the happening on the Japanese yield today or something, now somebody sit back and you should say, how does this matter? What happened to gold, or what happens to Japanese yield? We are long-term investor. Okay, no, it matters. Okay, and everybody is reacting. Today, let's understand whom you are competing. We are not competing with the domestic firm. We are competing with the hedge funds, algo desk, high frequency desk, a, a complex money management business which is run globally. Those are the participants you are competing with. So if they are ahead of the curve, then you will be lacking that if you don't understand things. So when we're talking about in a dynamic world, data is changing so fast and so rapidly. So why your money management style will be static?
Right.
Okay, and hence we say we are country's first dynamic way of money management. So we are first dynamic style of money management, asset management company, which is relying on data rather than saying I'm taking a conscious call on my gut feeling. A lot of people say it's my gut feeling. With my experience, I can tell you. Okay, yes, I am not debating the experience matters, but it is very difficult to quantify that. Okay, so our thing, the word quant itself comes from the background that we quantify everything, whether it's qualitative parameters or behavior parameters,
Right.
or as a combination, any analytics which we do, we try to combine and quantify. Now today you say I'm happy. Okay, can you put on a scale how happy you are? Or if you are saying fearful, now every fearful, you can say I'm very tense or very fearful today. Let's say market is corrected today, somebody say I'm very tense. Okay, now this is absolute terms. He may or can quantify also bit out of 10. Let's say I'm 8. Okay, but absolute number is important on the relative basis. What is the fear in the market versus your own fear? Are you more fearful than the market? If you can quantify that, you will be ahead of the curve.
Right.
See, this business is all, we will talk about risk. Risk is something which you have to assess. Now you cannot do a postmortem analysis. So when we always talk about, you should be ahead of the curve in quantifying the risk. It's not necessary that you will be able to foresee or predict everything correctly, which is not going to happen. But purely based on the analytics, if you can see what is coming, you are more prepared. Okay,
Right.
as compared to, and this is the game of psychological levels. Okay, somebody asked me this question, what you look at the, or which is giving most of the weightage. I think it's about the emotional aspect. Okay, people are emotionally disturbed today, let's say. Okay, this is very important, how you balance your emotional aspect. And this is the way the behavior aspect comes into picture. Can you quantify your fear? Can you quantify your greed? So we talk about known risk, unknown risk, or even perceived risk. Okay, the perceived risk can become known risk, or perceived risk can become unknown risk. That is very important for us to understand. And hence the importance of analytics is something, it's not about markets alone. I always talk about, for next generation, please focus on analytics. Go for analytical course, okay, or the management degree which you are taking. Ensure that you are covered with these topics. If you can understand analysis or analytical skill set you can build, then you can do any business. Is required in your own life also.
Right, of course.
And that is the crux. How we manage is through analytical approach. Now it's very easy to talk about this thing, but very difficult to practice. Now you can understand when I say we quantify fear and greed, it's not easy to quantify. Okay, and it's not on a scale that you feel it is 7, I feel 6. No, we quantify through economic parameters.
Right.
Okay, this is the level of greed or fear is there for particular asset class or stocks, or particular on country, on absolute basis as well as a relative basis.
Right.
So quantification of data becomes very vital, both in absolute terms and relative terms. Both are equally important.
Right. Okay. So if we take an example,
Yeah.
you talked about greed and fear, and I just want to understand this a bit more. Let's take an example. Okay. Asset class silver right now, for example, right? It's been in euphoria for last, I would say, 8 months, 9 months. 200% rally is what we have seen. as a layman, I can say that, okay, there is a mix of greed here as well as fear, because people who bought it, they are right now maybe fearing it. Should I sell or not? Should I just keep it, or will it fall because I'm sitting on 200% profits? On the other hand, there are people who might be thinking, did I miss the rally? Should I now get in? Because it could very well go from 3 to 4, 5, 6. So there are mix of emotions for a particular asset, and people are divided. How do you come up and say that at broad level there is a fear or greed? Is there a way to quantify that?
So it's a good question. Let me explain you how we approach that. So we look at data from longer term, medium term and short term or even near term perspective. Okay, that's the reason I always say investors should understand their risk appetite and their investment horizon. Very important thesis. Okay, now let's say example. In 2018, if you go and check our previous book, we have written in 2024, last quarter of 2024, a massive bull run in gold will start in precious metal. We have written the word precious metal.
Right.
A massive rally will start in precious metals. Okay. And which has its more legs. So now, how we got it? We analyze 100 years, thousands years of 500 years of data on cycle analytics. Based on some of our data we set from end 2024, the gold or precious metal start rallying, which did happen. Okay. Now, if somebody asks me from a longer term perspective, we have been saying for last few years, gold or silver should be part of your portfolio, and we have been vocal to say 10 to 20%.
Right.
Okay. Depending, every letter we have written positive about it, and this is a long term. However, in the month of July 2025, we also talk about some sort of euphoria is seen in gold and silver prices. We said 15-20% correction. It did correct to 12-13% correction. The correction was steep, but it didn't last it up to that extent what we visualized. We cut down our gold and silver exposure by 50%. Few months back, we rebuilt that exposure.
Right.
Okay. And last year in our beginning of 2025, we talked about the 2025 silver will outperform the gold. Okay. Which happened. Okay. Now, if you really look at prior to 2025, we were running gold as our exposure. But after that, we have running only silver in our multi-asset fund. And that's the one reason our multi-asset fund is the best performing fund in that category. Okay. Because we were not running gold, we were running silver. The precious metal outperformed, but silver outperformed the gold also.
Right.
Now, last week only we have booked some profit in silver. Okay. Again, we have not sold it completely because still we are convinced it has more legs. So what is very important to understand your investment horizon. If somebody says I have 10-year horizon, please don't sell your core holdings.
Right.
But if somebody says I'm a trader or I have taken only for 6 months bet or 8 months back, then I say please cut down your exposure. You have made good money and lie low.
Right.
Not necessary you have to go and short. Okay. Right. Given the geopolitical environment, shorting is not very advisable, but cutting down your exposure. So it's very important what type of investment horizon you are looking at. So let's say a lot of people come in the market and say that, I virtually came at the peak of the small cap cycle. Now I'm stuck. Okay. Because it's a very common thesis. At the peak of any cycle, the risk appetite of investor is highest and every investor is long term. Okay. It's a very common thing because your conviction is highest, so high. And conviction comes from price movement and the percentage change. That attracts you. Today, let's say everybody is very excited about gold and silver. They think this is the biggest blunder they have done by not participating. Correct? Now, if you come with regret, you are getting sucked at virtually at the peak of the cycle. Let's say from a medium term, not from long term perspective. So, what is important to understand? If at any given time, if you are coming to equity market, we always say you should put money in equity market which you are willing to forget for 5 to 10 years. So that you don't have to look at your NAV or your stock prices on daily basis because you have bought from a longer term perspective. We always say equity and asset class is long term, investors are long term, sectors and stocks are not. But as a money manager, it is our responsibility to figure out which sector and which stock we have to identify for you and run through that. So if I have to really conclude that any given point in time, we did some maths. and saying that if you have 6 years horizon, anytime you have come in the market and made a small, you have made money.
Right.
Even you have participated at the peak of the cycle. Okay. But you should have conviction to hold for 6 years. The problem what happens, you buy at the peak prices and the bottom you get capitulated. You give up at the bottom, ki now my patience is tested, this is my stop loss, I am moving out. That's the where people make mistakes. So when you come to the equity market is all about long term. Okay. If you have that mindset, then only come, otherwise you should put money in balance fund or multi-asset fund. So if you don't have that risk appetite, and this is the problem, okay, where I generally, a lot of people say, I have to talk to my wealth manager or I have to convince. No, you have to just sit down and analyze your own behavior. You have to measure your risk appetite. Now, how you measure it mathematically, I can define it, okay. Your risk appetite, you have to see how you behaved in 2000, suppose you were there, how you behaved in that 93, 94 or 92, 93 peak, how you behaved in 2008, how you behaved in 2018, how you behaved in 2020 when market, these are the things where market make a very important top. Whether you got capitulated after the first fall, second fall, or you got exited at the bottom of the cycle, or you did the reverse. You were able to participate at the bottom of the market. Okay. So your behavior, if you are exiting at the bottom of the cycle, it means you are not a long-term investor. You are a short-term investor. You are a medium-term investor only. You are not a long-term investor. Long-term investor actually look for buying opportunity. He or she could have averaged it out. Right. Let's say COVID fall, lot many people participated, but some people have virtually given up at the bottom. When 30, 40, 50% fall happens. So it's a characteristic of a very individual which you can only analyze. Nobody else can analyze on. This is a very important trade. You have to measure your behavior. Whether you are impulsive trader or you are long-term investor or you are patient investor or you are hyper investor, depending on the terminology and depending on your mindset, and you can only gauge how you have reacted. Your risk appetite and your investment horizons are very vital tool for your success in the stock market.
Okay. If we talk about data, so you said data is God. I quite like that because then it removes all the opinions.
Yes.
And it removes the biases and it tells you a story. For 2026, what's the story? I want to ask you, where do you see Indian stock market? Yeah. Okay. Where do you see, for example, Nifty or broader indices? Are you for bull run? Are you for bear? Or you are for more like sideways, low single digit returns?
Okay. I'll answer it slightly differently.
Sure.
Okay. Instead of getting numbers, it's not very good to talk about specific numbers because it may or may not happen. Let's say beginning of 2026, what we go back and look at the history, what we said in the beginning 2025, how it performed, and what are the macro factors or other local factors which are there, which will help me in predicting the future. Okay. So based on multiple predictive analytic thesis, how I look at 2026, the way we describe in one of the show I talked about, 2025 was disturbing. It was disturbing or difficult 2025. So very difficult 2025. People didn't make money. Though indices came back to all-time high by December, but your portfolio was severely affected. Similarly, I'll say the beginning 2025 is fragile 2026. And I use the word fragile 2026 not for India context alone. I'm talking about global first, okay? Because we are a subset of that. If the global equities, you have a perspective, you can understand where we are heading. So we talked about fragile 2026, and I also said 2026 will remember as a PE contraction phase.
PE contraction.
Yes. And let's understand how I derived with the PE contraction. It's very easy to make a statement. How I derived. Let's look at broad data. If I have to summarize, the global risk appetite, okay, has peaked out and started shrinking. Okay. Global risk appetite peaking out, global liquidities also has started drifting down. Okay, cycle peaked out somewhere, let's say in September, October 2025, like global liquidity cycle, and it's drifting down. When risk appetite and liquidity start drifting or correcting, which means the P market has to correct. Earnings will gradually expand. What drives the prices is earning expansion and multiple expansion. Earning expansion will be there continuous basis because we are growing. So I'm not concerned about earnings. Maybe the momentum could be less, but they're still growing. But P contraction will happen, which means you will find it extremely difficult to make money in 2026. Now, when we say about P contraction, why I'm saying that? Because we saw complacency getting built in the US market. Okay, the way developed market and particularly US has done extremely well. All India was one of the exception last year. All the global equities has done extremely well. Okay, there is good amount of hype and people are very complacent. Okay, for them everything is buy on dips now. Okay, irrespective of geopolitical noise, markets have done extremely well. So we are seeing signs of complacency, which means if I have to reverse calculate and say vulnerability is very high for global equities, US equities in particular. Okay, and what did very well in 2025 was all about AI theme and that bubble which people talk about. I will not call it bubble still in US. Okay. I will call it a maniac phase. Okay, bubble is something very different. I think we have still not reached a bubble in US because valuation have not stretched up to that extent to call it a bubble. Okay, but it's a maniac phase where extraordinary hype is getting built in the market and that needs to correct, which means from a medium term perspective, I am more cautious and negative on the developed markets, particularly US market. Now, if we say US market corrects, if US market corrects, then every market logically will correct because that is the mother of all exchanges. It has its own sentimental value. But keep in mind that last many quarters, India has underperformed and we have negative correlation with the developed market, particularly with the US market, which means India has a potential to outperform the global equities. Right. India has a potential to outperform US market, which means even we fall, let's say, along with the global market, we have potential to come back or bounce quickly because of the underperformance characteristic which we have seen or some of the data which we are looking on statistical basis is giving you. Right. Now, in every market, some stocks will go up, some stocks will go down. Let's look at now. If I'm a long-term investor, people are, oh, if you're worried, should I take out my money? I'll come back again. No, nobody can time it so perfectly. What we are saying that if it's a PE contraction phase, what as a house, as a quant mutual fund, we took this conscious call in September 2021 also. I said the growth cycle is speaking out, value will come back. Right. So this is the paid with all high PE multiple stocks, over admired territory stock, all hype stocks, so-called new age, EMS space, and many in name of robotics, semiconductor, hardly anything is there in India. But whatever is there, they have gone to the roof. Right. All those names, if they will correct globally, I think damage in India will be far bigger because it's not backed by earnings. Right. Okay, it's all story which we have seen. People have just extrapolated the numbers on the growth front, not on the earnings front. Only on the top line basis, people are very excited. In 2024, when we talked about in July 2024 that India risk appetite has peaked out and started drifting down, which clearly means that the vulnerability, what we saw in 2024, we were very early to talk about risk off period for India, though it started correcting from September, December, but risk is always predicting earlier. We are seeing something similar characteristic getting built for US market right now, and hence I'm cautious. Now, it took 6 months time or 3 to 6 months time before you felt the impact of the declining risk appetite, declining liquidity in India. Something similar I see this year for the US market. So I will avoid any global linkage stocks in terms of P, since we are talking about a global derating story or P contraction phase. I would like to avoid such names where we think the opportunity could be different. Okay, right. So it's all about how you look at these markets. Now, one way of saying that, oh, these markets are bad. No, I'm saying I have identified this type of pocket or this type of stocks we are finding challenges. Let's look for opportunity. So what is opportunity in 2026? If I'm saying P contraction means growth will underperform and value will outperform. So one logical thesis is value stock should be looked at. Second important conclusion is identify the neglected, beaten down names which has been underperforming for last 1 year, 2 years, 3 years, and they generate good amount of cash. Okay, they're both operating or let's say free cash flows are on a higher side. For whatever reason, market have ignored that because India economy was in a difficult phase. So their top line or their growth momentum was slightly slowing down with the GST benefit and income tax benefit. Actually, India macro is actually improving, if you ask me. Irrespective, when Indian macro was deteriorating, market was still rewarding that.
Right.
Okay, now reverse is happening. Macro is actually improving, but markets are reacting in a different manner. So that's the way the important sentiments come into picture. So 2026 is all about, let's say, identify neglected, beaten down, neglected stock, where some amount of under ownership is there, hatred feeling is getting built. These are the stock not to be touched. Those are the stock we have to buy in 2026. So it's every year, in the beginning of the year, we try to identify these themes. Okay, it won't be so perfect. I'm just giving you, let's say, small example. Beginning 2025, market started correcting end December 2024 and beginning 2025. I distinctly remember in our newsletter and various forum, people asked me this question: how difficult will be 2025? Okay, so I said second half of 2025 will be better than the first half, and within first half, first quarter will be worst. But by end of 31st December 2025, market will be significantly higher than 31st December 2024. And in September, October, we talked about making all-time high by December 2025 itself, which happened. Okay. Now, are we astrologer? Are we God status? Absolutely no. We are slave of data. This is what, when we combine data, we get answer. Do we get it perfectly? No. 72% time we get it right, 28% time we are wrong. Okay. So that is also mathematically decoded. What is the success rate?
Right.
What is the failure rate? So in certain cycle, when somebody invested in a phase where our failure rates were higher, okay, he says fund has underperformed. Somebody invested where our success rate was very high. Okay, it's a mathematical number. This game is all about probabilities.
Right.
Okay, so when we talk about predictive analytics, we say it's not a deterministic science. I cannot say with certainty, it's a probabilistic science.
Okay.
Okay, so how beautifully we defined a predictive analytics, a probabilistic science.
Right.
Which means we are trying to predict the probability of this happening versus not happening.
Okay.
And if you can do that on with the help of mathematically, you will be more successful. And that's the reason when we get it right big time.
Right.
Okay. When we get it wrong also, we will get it affected for time being, but that's a thesis we follow. Now, one approach is that you go and play the same music, everything is long term, I buy for 10 years, these are the blue chips name, these are the blue chip company, these are the best management. We are not believer in that. Okay. Because cycle changes. Some of the companies or sector don't exist today. If you go back in the history from 1957, you try to see, okay, I'm talking 1957, how Sensex have changed. Or you go and say even what was there in Harshad phase, let's say 1994, how many stocks in Sensex are still there? Majority have moved out.
Right.
Some of the company don't exist today. Okay, and in those days, if they were Sensex companies, which means they were blue chip companies. Now, if you have given this definition of blue chip and they don't exist, then how you behave? This is the bogus thesis. Okay.
Right.
This is where the research angle come into picture. We as a house continuously analyze the changing trend.
Right.
Now, if I'm saying today the growth will underperform or the high peak stocks will underperform, that does not mean I'm negative on them. This year it may not work, so I'll rebalance my portfolio in a dynamic manner. Okay, so my churn can be high. But ultimately what I'm trying to do, I'm trying to reduce the risk in my portfolio based on my understanding of market and the analytics which we are doing, what my analytics are endorsing. I will follow that rather than some big house saying that this is a bad stock or I'm downgraded. Does not matter. Some best of the economists actually failed.
Yeah.
Okay. So it's not about the consensus part. We don't take anti-consensus trade, which a lot of people ask. Okay, you are a contrarian investor. We are not contrarian investor.
Right.
Okay, we might be looking like a contrarian investor, but we are actually data driven.
Right.
Now let's say example this year, the risk which we highlighted. Okay, now we were very early in 2018 to talk about de-dollarization. Okay, this whole battle which you see today happening globally. Why Trump attacked Venezuela? Now somebody says he's the biggest goon, he is threatening, this is not the way to do it. Let's understand US philosophy. US, what is make US different? Because they have reserve currency. Dollar is a reserve currency. When US is realizing their importance of or the supremacy is going to decline, and that's the time they are fighting that battle. Okay, let's understand, and I look at everything from a data perspective. Okay, now in 2022 when DXY was about to break 92 levels and Soviet Union attacked Ukraine, there was no need for US to interfere. It was a local phenomenon, how India Pakistan happened, or something happened recently in Thailand or Cambodia. It was two regions, small issues. Okay, US jumped into it because they felt this as opportunity to control the dollar. Otherwise, dollar could have lost value, and America could have lost their relevance much earlier than what we are also forecasting. Okay, from 92 it became 110, 112. So they saved the dollar. Now, if I have to look at very recent example, Venezuela, what is the problem? China has very subtly from back end has captured or has a say in the commodities market, and they have started trading in yuan. They have captured Africa, they entered into South America, where US was only focusing on the Middle East. Suddenly they realized that the relevance of China has moved to the next level. They control 70% of the global commodities. At least they have a say, or they, if not 100% control, they have a say on. Today they dictate terms on the commodities market. Look at the rare thing,
rare earth and silver as well.
Yes, US has to bow down.
Yeah.
Okay, whether we like it or not, that's a fact. The tariff barrier, the problem started with China. He said China is the biggest enemy. They want to teach a lesson to China, but ultimately they penalize us and others. They could not do much with China. And this is what we have to understand. The recent Venezuela battle, or the whatever he has captured the president, is all about because they have largest reserve, and they're all reserves predominantly who was taking, China was taking, because there was a lot of restriction. He still was taking, and it was trading in yuan. The petrodollar with the Saudi, the agreement, 50 years agreement just lapsed. This is all about data. Now people say, well, trade deals are not happening. It's an ego battle. No. The real battle is, the problem started the moment BRICS announcement came, and BRICS, he has threatened if you get into that. Now, if you connect the dot, you will get answer, because we are a very important player in BRICS, and hence they cannot do much to Russia, they can't do much to China. So we are the third most important player in that segment or the BRICS territory. We have been penalized. We think Brazil will be the next to be penalized.
Right.
Okay. So if you start, this is how we connect the dots. Now, after, let's say Venezuela, which is the best other country produce? Nigeria, very large producer of crude and reserve. Okay, you already seeing trouble starting in Nigeria. Okay, conflict is going on. Who is sponsoring this conflict? Conflict going in Iran. Who is sponsoring this conflict? Okay, somebody is sponsoring this conflict also. When we see problem in India, and we always talk about somebody else is sponsoring these events, because every big country wants to make other country irrelevant, or they don't want to make them put them in check. Right. So they will create a problem for you. Their supremacy goes down. Today the global battle is not between India, it's China and US, which is fighting a battle of supremacy and relevance of dollar. And that's the reason other things are side effect. Once you start connecting the dot and understand what is coming. Today somebody says next crisis Nigeria. I can tell you in black and white. This is visible from a predictive analytics. Next big crisis is Brazil. Today we have seen rupee depreciating significantly. If you ask me my 3 years view for Brazil, their currency will come down drastically. All the BRICS country, the currency attack will happen. This is a larger thesis. If you understand this is the way how we predict markets. Right. Trying to look at data, and sorry, I got into a different tangent altogether.
I got lost myself, because the way you were explaining all these events, and how they get connected eventually, and we come down back to the markets.
Correct.
Because market doesn't really work in isolation. It's looking at all these factors sentimentally, liquidity wise, everything is then getting impacted. I gathered a few, while I was very patiently trying to listen
Let
to
me
you.
add, all wars happen globally. It's not about ego battle. All battle happen for economic reasons. All, whether it's World War One, Two, or any battle happen, is only happens for economic reason. And if you can decode that economic reason, you can predict. This is the way we call a concept of market implied analytics. How we predicted silver movement, how we today I'm saying Brazil this will happen or Nigeria will happen. It's a reverse engineering.
Right.
So market implied analytics, what market is implying, if you can read, then you can foresee what is coming.
Right. I have few questions.
Yeah.
One of them is, you talked about high P stocks are going to face tough time in 2026.
Not only high P, high valuation. There are many
valuation.
companies does not have a P also,
Right.
because they don't make profits.
Of course. We know the names.
Yeah.
Now, if a company has a P, they are earnings is positive, hence they have a P, positive P. What do you consider a P as a high P? I just want to get, and I know this number could change. 20 years back, it might be 20 Ps, towards the high. Do you think 40s is the new 20 now? Or is it 60s?
So I will put it very in an interesting manner. This is again a bogus thesis which we have been taught of PE bands.
Right.
Okay, I'm slightly critical right now.
Okay.
Okay, because it's a band you follow. Okay, it went up to 40, goes down up to 10. So if 40 band comes, I will buyer. If it comes to seller, if 10, I'm going to. If you really sit down, best of the analysts in this country, what they forecast earnings. Earnings are important, but in your price discovery or price forecast, earnings and valuation multiple both are equally important. Why nobody forecasts valuation multiple? Have you ever seen a report saying that the valuation multiple will expand to these levels?
I have seen. So for example, a few reports I have seen, FY26, FY27, EV multiples will be this, PE multiples will be this. So they do give us that sense.
No, it is again based on some bands and some thesis.
No.
Okay.
No, that is based on the earnings. So what they say is typically what I have seen. In fact, with my limited experience, they would say that, okay, top line of this company by FY27, let's say, is going to grow by, let's say, 30%. So they arrive at that number and then trickle it down to EBITDA, trickle it down to the PAT and say that, okay, earnings per share for FY27 is looking like it's going to grow up by 22% because the top is going at 30%. And therefore, if you buy today's price, then the forward PE multiple for this particular company is looking like, right now, let's say it's 40. For today's price, it's going to be, let's say, 28. So they give that number in terms of the valuation, and they do give us the EPS. I've seen a few research reports, but I do not know. My question is the confidence there.
No, what is the thing? So what they are actually forecasting earnings, and this is based on this. P looks cheaper now if I look 3 years forward.
Right.
Where we are coming from, where we say, for us, P we quantify through perception analytics.
Right.
Again, a behavior data. Okay. When we say India is expensive, okay. Today, let's say after correction, India is the most expensive market in the emerging market space. Okay. Despite India has underperformed and we have corrected, still our valuation multiple is still the highest in the emerging market. Now, somebody says that it was expensive. When it was very expensive, people are buying. Now it has corrected significantly in last 1.5 years, but people are still not buying because still expensive. No, that's not the way. We have to look at something has changed in India. India perception multiple has moved up. We believe that India multiple will remain expensive for a longer term perspective. Our forecast is based on our predictive analytics. By 2047, when the India's demographic cycle peaked out, Indian P can remain elevated till then, because P has lot of things to do with the demographic cycle. How Japan peaked out in 87, how China cycle has peaked out on the demography, and how India is a beneficiary. Today, people also criticize about population. Today, that population is actually helping us.
Yeah.
Okay, we are the youngest population in the world. And these are one of the important factors. So we get into multiple factors, and that's the reason I say India is expensive and India will remain expensive for next 2.5 decades.
Right.
So you have to keep back of your mind, the valuation multiple will not come down significantly, and hence whatever you do, you have to keep mind this some band has changed. It's not about that something. The multiple is not about the P expansion phase. The band itself has changed for India.
Okay.
Hence, it will remain elevated. You had to accept this is the band I have to give. If I am giving a higher multiple for the country itself, which means logically I will give higher multiple to the companies also. Okay, and hence this absolute value of 5 multiple 10, 20, 50 has no relevance. It has to be looked into relevance from a context perspective. What was the P band now? What is the perceived band in the future? How it looks from an India perspective, how we look at on the relative basis. So on that basis, we try to say, today, let's say if you are saying P contraction phase. I am not predicting that the P will contract by 40%, 50%, 30%. What we are able to identify the inflection points. Okay. For me or quant mutual fund as a house is all about inflection points. We are seeing this inflection point is peaked out. I will try to exit from these names. Okay, and wait for opportunity. I don't have a gauge status tell you the P will correct 30%. A lot of people forecast this level has gone down, this is the next level, or this is the minimum fall it can happen. We don't have that skill set. What we understand, I will look for if we are seeing extreme situation, when we hit the other extreme, I will wire.
Right.
So both extreme scenario, we will try to participate rather than saying how deep it can fall or how high it can go up.
Right. Okay, understood. So, couple of questions then. One is on Nifty valuations. So, Nifty PE. I think we are at 21, 22, depending on when my viewers are watching, but roughly 22 multiples. And emerging markets, if you look at, maybe majority of the countries would be, let's say, 15 or 16, not more than that, right? And you're absolutely right. We are still the costly one. And what I understood is that we would remain the costly one.
Yes.
Do you have any thesis to say that if the PE multiple of Nifty crosses a level, it could be, I don't know, 25, 26, 27, that's where we have a bubble, or that's where the valuations are really stretched?
So I will look at P as a matrix, P and the growth put together.
Okay.
Okay. So obviously higher the growth, higher will be the P multiple. That matrix makes more logical sense rather than just looking
PE absolute.
P. So PEG is a better data point to look into the data. That's the first point. Second important point is that P also depending on the various environment. If your risk appetite and liquidity is rising, P will keep on rising. Okay. When my risk appetite and liquidity peaks out, that's the reason I will try to say this is the peak of the cycle. Today, what I'm saying for the global market, that the cycle is peaking out because liquidity cycle is already drifted down, risk appetite started shrinking. Hence, I'm saying that we have reached a stage where these global indices and US indices particularly has a potential to get derated because that event has played out.
Right.
Something similar. Now, India is not neither in that situation nor India is an extreme bottom.
Right.
So, somewhere we are now in between. Rather, I will say we have seen a meaningful correction of 6 quarters now.
Right.
It means whenever cycle turns for India, we will be the first country to outperform now.
Okay.
Okay, that's the way I will look at, and that's the reason I'm saying don't exit, rebalance your portfolio. Right. This is what we try to do, because if you exit, you will not able to participate again. Today, I always say in a risk on period, we generate extraordinary alpha and keep it for difficult time. In difficult time, you will just protect it.
Right.
Because nobody can predict so perfectly this is the exact bottom or this is the exact top. We are trying to identify ultimately let's understand money flow analytics, a very important thesis which we have built up. How money shift from one asset class to other. Mm-hmm. How money shift from or stock rotation or sector rotation. Okay, this is a thesis which we understand here is stock rotation or sector rotation is going on. Now, the first most important thing is that let's say entire world is combined global world. Okay. Today, when people say, when Economic Times write front page news, today, $5 billion market cap wiped out.
I love those stories and I laugh at them.
Okay. Now, in absolute terms, they are absolutely right.
Yeah, there's nothing wrong in the data.
Correct.
It is true data. Correct.
But if I have to look at the world, I look at you have lost, I have gained. because you were long, I was short, I made money.
Right.
In certain scenario, I have lost, somebody else it made. Okay. So in totality, you have, it's like money has not moved out. You have lost and I have gained.
It's
So you are
gone
showing,
inside. Yeah, okay.
correct. So because you are looking at one asset class or one particular sector, only let's say equity, and you are saying that, what happened that money moved to the properties market?
Right.
Somebody book profit and money has gone to the real estate. This is what happened typically when people make a lot of money. Maximum money gets shifted to the real estate because that's the hard assets, or it goes to the silver or gold, which is hard asset, and some other hard assets also there, which people don't talk about in India because these are the more common one. So what is very important to understand from a global perspective, that money shift. This is what the phenomena we call it, money flow analytics. Right. It's a very interesting. So money flow analytics is a function of risk appetite and liquidity in very simple terms. When liquidity and risk appetite both are high, money flow is high. When both reverses, money flow is less. So let's say today what we are saying, US market risk appetite is peaked out, liquidity shrinking. It means whenever markets start correcting, money will shift to Asia or emerging market much faster now, because that cycle, money shift from high risk to low risk environment. When you say, an investor say, oh, this is P is very expensive, let me sell high P and buy low P. He is also doing the same thought process, but here we are quantifying mathematically through numbers. Okay, and this is also very interesting characteristic. Like pension fund is the last guy, most conservative guy will get capitulated at the bottom of the cycle.
Right.
Hedge fund will be the first guy, early signs of tremors, he will be out. He might miss out something, but he will play safe. The moment he say volatility, he will out of the game. Okay. So what is very important to understand the characteristic of a person, and this is the money flow analysis. When we do give weightage, how we arrived the risk appetite. It's an economic number. Purely on economic indicators, we are capturing liquidity and money flow.
Right.
Okay, liquidity and risk appetite. It's not something, these are technical level, this level breaks, so this is high, this level breaks. No. This is absolute mathematical number derived through economic parameter, and you can quantify. It's a very interesting thing how you quantify. Again, absolute point has no meaning in life. I'm a student of theory of relativity. I will say the relative thing is very important. On a relative basis, I will shift from here to there.
Right.
This is more risky, this is more safer. I am not exiting the market, I am shifting. This is what we keep on doing in terms of rebalancing. So today in 2026, whether today markets were down, I am tense. From my face, you cannot figure out. I am not tense. We were mentally prepared. We have been saying that it's going to be a
volatile,
fragile 2026, and we are saying peak expansion. We have already started. But sometimes you get frustrated. The pace which market sometimes corrects, nobody can predict.
Right.
We were expecting that we will do it. So the frustration will come. Your execution is not to the perfect because market is brutal. The impact cost, now this is very important thesis. I have been shouting for a long period of time that India impact cost has gone up and it's remain elevated. And this is a worry which we have. Okay. And that's the reason every forum we talk about. Your portfolio has to be liquid. The liquidity gives you peace. Today, by the priority of my quant mutual fund portfolio, liquidity number 1, safety number 2, returns number 3.
Right.
In this period. When cycle reverse, it will be other way. Returns priority. Liquidity second, safety is the last. So it's a question how you change. But that does not mean we are exiting the market. We are saying bye-bye. No, we are, India long-term structure very good. If somebody asks me next 3 years, can be challenging for India, but our league will change. Today, let's say we are seeing the pain of deal not getting signed with the US. Okay. Many companies are affected. Now, if I look at many entrepreneurs, when you talk to promoters or entrepreneurs, whomever was concentrated on US are now changing. They have understood the concentration risk is very high. In 3 years time, you will see today, look at India net export number has gone up despite US has put so much restriction. Okay. Now somebody can say it has gone up because dollar has, maybe it could be part of a strategy. Who knows? I look at combination. Net is not impact is not that meaningful. What is the number? 2.15% of the GDP is linked with US. Hardly anything. So in percentage it looks small, but for certain sector it's very large number. So what is saying? A short-term pain for entrepreneurs, for maybe, when I say short-term, could be 3 years also. Okay. But in 3 years the cycle will change. How the stock get re-rated, because we as an investor see how this management has transformed the journey from dependent on one country, which was the biggest country. Now is well diversified. Today, look at, we are very happy. This deal is not happening. EU deals can be signed by what we are hearing 27th. They are coming, so they can be signed. All bilateral agreements are getting settled. So it's a great news. We could not do one, but because there was a problem, at least government official has put an effort. We see the Commerce Ministry, Piyush Goyal, going around on multiple places. Okay, look at the effort country is putting in looking, and industry is working very closely with government. So look at the positive side. Yes, short-term pain, long-term gain, and this is the way how re-rating happens. So if somebody says, I want to exit market, you say it's fragile and no, you have to keep, because next 3-5 years looks very good. We are saying that we are in structural bull run in India. We think till 2047, 2050 is a massive bull run in India on a relative basis. Our macros are better than developed markets. Both on absolute basis we are good, on relative basis we are even better, despite we have underperformed.
Right.
Okay. So everything is not should be linked with the market. He says bhav bhagwan hai, bhav batata hai problem, and no. Okay. Market is always ahead of the curve. Okay, so what we have to understand that how well you can capture some of the opportunity which is coming in this fall. Also there are opportunities which is emerging. I will sell something and rebuild something else. Okay, so it's not about, sometimes people come and say, oh, we book losses there. So that is a very wrong approach. Okay, people say, oh, in this stock you lost money. I don't look at stock specific, I look at portfolio basis. If by selling something at loss also I'm able to shift and move to the park somewhere else with a better return or lower risk, I should be happy about it. Nobody has a God status to tell that you will not. This is the way learning is all about. This is the way markets are all about. It's a very dynamic philosophy which we follow.
That was fascinating. Thank you so much. I think there's a lot of things here that I'm going to take back and digest and reflect on it. I have few rapid fire questions for you now.
Please.
Do you remember your first stock and did it make profit or loss for you?
I will not say first stock. In Harshad period, I sold my family portfolio, and not one stock, I sold the entire portfolio.
Right.
And we made money.
That's good. That's good.
So that period was good period for me.
Okay. In the last 33 years, you've been in the market for 33 years. In the last 33 years, what's that one thing that you have truly mastered about the stock market?
I will not say truly mastered, but I'm relatively better off than others. It's about emotional attachment. Okay. I have seen people, we all talk about we should not have any attachment with stock, but it's very naturally you get associated with sector stocks or certain management. This is what I like, this is what I admire. So that when we get into this predictive analytics or purely data driven organization, our biases goes down. Okay. So we say we are unconstrained fund house. Okay. Right. We are style agnostic, market cap agnostic, thesis agnostic. Okay.
Wherever
management
there is
agnostic.
An opportunity, that's where you're going.
Pure opportunistic approach.
That's good.
So that is something which I think I'm able to differentiate others, and that's the reason my attachment with the stocks is not there.
That's great. That's great. In the last 33 years, what's that one thing that you're still working on when it comes to stock market investing?
So the only challenge which see, because I started the money management business bit late, because whole life we were doing analysis or running multiple businesses, but not in the money management side. We were used to manage our prop money. The challenge which I see, because I've been 33 in the market, I'm carrying some biases in my head. I call it preconceived notions.
Right.
I have grown with that. And that I find it very difficult how to get it off. I know this is not good. This company or this management, this is like preconceived notion. Sometimes when you have dealt with somebody or seen it very closely, those preconceived notion get built and it is there in your subconscious mind.
Right.
And you are not able to dilute them or get rid of. That is my biggest problem.
Okay. What's that one thing that investors should stop doing immediately in India?
First thing, don't look at your stock prices or NAV on daily basis or minute to minute or hourly basis. That's first thing they should stop.
Any book that has influenced your investing style a lot, or any book that you recommend to my viewers?
I will not recommend any book. I am not a great believer of one thing, but I have learned with a lot of interviews with people, whether Jim Simons of the world or best traders in the world, or they are very renowned people on the behavior side of the market. So their experience or their interview gives me a lot of insight, because there's no books which is there who talks about, because like we talk about Jim Sam is a mystery, nobody knows what he has done. Okay, so sometimes these interviews or their perspective give you how they react, or sometimes you watch them listening or hearing them. That's a great learning for us rather than just looking at one particular book.
Okay. Who has influenced your investing the most? Do you have any role model?
I think Jim Simon could be one person which I can say still very curious to know how exactly you build, because we are trying to do something similar in this manner, and so it's a if I have to say a role model sort of thing, is there in the subconscious mind how mathematically and scientifically he built a phenomenal organization.
Right. Okay. Thank you. Who should be my next guest that you would like to listen to or watch?
I'll recommend, but they will not come.
That's absolutely fine. I'll try my best. And the max I'll get is a no, which is fine.
See, I tell you, since we have grown in India and they're legendary investor, whether you talk about Radhakishan Damani, you talk about Nimesh Bhai, Rakesh Bhaiya is no more. These are legends. Okay. So, and you should learn from them whenever we meet them, an opportunity in a function or on basis. Okay. It's a learning how, what, and they're very calm, very satisfied investor. Something is very calm thing. You have to be settled investor. You cannot be very hyper investor all the time. So these are the two people. If you can get them, they are very media shy and they are low profile guy. He will not come. You can try.
I'll try my best. I know the answer anyways, so I don't lose anything.
Yeah, they're legends.
Yeah, of course. Yeah. Okay, Sandeep ji, thank you so much. Truly admired your time and truly appreciate your conversation. I think I'm taking a lot of things back with me, and I'm sure my viewers would have liked this one. Let me know in the comments anything that you would want me to come back to, Sandeep, and ask your questions. Happy to do that offline as well. Thank you.